I literally, I stepped aside, I just watched it because I was the time. I see, I see. Yeah. And if the sheriff, somebody sharing the camera, that's not. Yeah.
Oh, 55. Sandra.
Ethan.
Ethan. What's your last name, Ethan? With a Z? Okay.
Yeah. I don't think so. I haven't seen it. I think it's hot. Oh, there you go. There you go.
Dark.
Wow.
Okay. Okay, I think I'm ready finally. I brought some extras. Does anyone, we need to either like bring up on your computer or, if you're a pen and paper person, print this out and bring it so that we can work on it together. So if you haven't printed it out and you want a printout, I have extra. I had lots of customers this morning, so I printed extra. There we go. Okay, I still have 5 more. Okay. There you go. Okay, so now I'm out. You're welcome. Okay, if you downloaded the class notes, anytime before like 12:40, you should download them again now. Oh boy. Hold on a second. All right, can you guys online hear me now?
Yes.
Okay, good. Thank you. Thank you. Someone unmuted. That's awesome. Thank you. Okay. Yeah, I just changed something that I've had in there for years, and I think it's confusing to students. And today, between the first and second class, I said, why do I just do what the textbook's doing? I can just change it, and then it's going to be less confusing to students. So I had that amazing brainwave. I don't have to do it the way they said. Oh, actually, I have one more for this side of the room. Anybody? Okay. Okay. So we're going to work on this same package on Thursday. So just bring this back on Thursday. It's Tuesday that we have a new one. Okay? So we're doing current and non-financial liabilities today. You can see the first principles definition there. Liabilities have 3 essential characteristics. Good to quote definitions like that when you're writing a CFE case, for example. CPA Canada Handbook 1, the conceptual framework. Handbook 1, is that IFRS or ASPE? Handbook 1. There's part 1 and there's part 2. There's actually part 3 and part 4. The 2 that we focus on mostly are 1 and 2. Which one is ASPE and which one is IFRS? You have a 50-50 chance. Yes, it is. Yeah. Part 1 is IFRS and part 2 is ASPE. Like, just for your next game of accounting trivia with your friends, you know, just so you get the right answer. Okay. See how I gave you the first principles definition of liabilities? We know that's IFRS because it's handbook 1. And then look at that, just a little quick concept check. So I just gave you the definition, and now I'm giving you a multiple choice question on the definition. So what is the answer, A, B, C, or D? And you guys online, you know, you can type or unmute. Yes, it would be C. It would be C. A present obligation for which an entity is the obligor. Good. Okay, let's do online assignment question 1. Now, this assignment is not due until a week today at midnight, but it would be good if you are already done. Usually, after we get through the first 2, these online assignments are going to be due at 8:30 on the day we start the topic. So either a Tuesday or Thursday at 8:30. And they always iterate, so you probably won't get the exact same question, but you'll get one that's modeled after this. So Upland borrows $40,000 on November 1st, 2027 by signing a $40,000 3-month 9% note. The fiscal year is December 31st. Show the journal entries related to the note. So what we're doing here really is A, just going over the accounting for a note, and B, just learning about the conventions for how we describe notes and what assumptions you can make when I just tell you information about a note. Okay, so this is just the convention that's used everywhere. So we have a $40,000 note. I haven't said when payments are due. So if I say nothing, that means interest and principal is due on the maturity date, nothing in between. If it was different from that, I would tell you. Okay? So on November 1st, we get the loan. So what would the journal entry be to just record the receipt of the loan? Yes. Yes, we receive cash, right? Usually cash is the easiest thing to track. So when you're doing your journal entries, if there's any cash involved, get it down first because it sort of anchors you. Oh, I got $40,000 as a loan. So I'm going to put note payable for 40. Okay, that's good. And then I've set up a frame here for an adjusting journal entry. On the exams, I'm going to give you like a framework like this, but it won't be chunked up. It's just going to be a big long list of lines. So I give you this framework so that it's tidy and I can read it and it's not all over the place, but it's just a big batch of lines. So I won't hint to, like, this is a pretty big hint that you need to do something on December 31st. On the exam, I won't do that. You'll just see a big long table with lines in which you can write your journal entries. On December 31st, something needs to be done. There's not going to be any interest paid. The principal's not going to be paid because this thing is not actually coming due until February 1st. So what is the adjusting journal entry that I need to do on December 31st? Yes. Yes, we need to accrue interest. On the exam, I'll say, here's a note. Show all the journal entries related to the note for fiscal 2027. And then I will say nothing else, and you'll see this big table. You have to remember that you always have to accrue interest at period ends for interest-bearing notes, any interest-bearing financial instruments. So debit. Does anyone want to tell me what the journal entry is? Yes? Yeah. Debit interest expense and credit the payable, because we're not actually paying anything, it's just payable. The way we calculate the interest, we're going to take our 40,000 times 9%, and then we're going to prorate it. So it's November and December, 2 months past, times 2 months. Oh, is it over 12 or is it over 3? Because it's a 3-month note. 12 or 3? You want to say it louder? It's 12, because that's another convention. We always quote interest rates on an annual basis. So it's definitely 2 over 12, which is 600. Okay, so that's it for the fiscal year, but we're going to keep going. Go to February 1st when everything gets settled. So let's settle the interest first and then settle the note itself. So for the interest, we still have 1 more month's worth of interest expense. Yes. Yes, I can. And you know what else? This should be, hold on a second here. There. Okay. So we still have 1 more month of interest expense. Debit, interest expense, it's going to be 40,000 times 9% times 1 over 12, right? What else do I need to do? If I'm settling all of the interest, right? It's all due, yes? Yeah, I won't have a payable anymore, right? Because I'm paying it right now. So I need to get rid of this interest payable off my books. So I'm going to debit it. Now it's going to cancel out. And yeah, the amount of cash that I'm going to pay out for interest is the 900 for the full 3 months. And then I'm just going to settle the note. Remove the note by debiting it. Now I've cleared the note off my books and I had to pay out cash. Everybody good? Pretty straightforward. Okay, let's keep going. Pendleton department stores. Pendlebury. Okay. So this is like a question with just a variety of little details that we need to know for current and non-financial liabilities. So let's just, I'm not going to do every single one of them. I'll do most of them, but not every single one of them. So they follow ASPE and they have a periodic inventory system. Their year end is December 31st. Okay. On February 2nd, they placed an order to buy goods from Hashmani for 46,000 plus HST. Terms of purchase are FOB destination, net 15. The goods arrived February 6th and the invoice was paid on February 20th. So I see 3 dates here, February 2nd, 6th, and 20th, but there's only 2 frames. So what dates are we going to do journal entries on? What are the 2 dates? Or just tell me which one do we, yes, at the back. Yes, the last 2. The fact that we placed an order is just whatever. I mean, we have a commitment to accept those goods and pay for them, but we don't have an actual transaction yet. So yeah, it's just the 6th. So let's do the February 6th. They have a periodic inventory system. So am I going to debit purchases or inventory for a periodic system? 50-50 chance again. Yes? Okay,
February 6th changed. February 2nd.
if what happened?
If it was FOB shipping point rather than destination, that initial date changed. Second, because it's like that.
If you assume that they shipped out the instant we ordered, yes. Yeah, it depends on when they shipped out, which they haven't told us. The order alone doesn't do it. You're right. It's when kind of the risks and rewards transfer. And when is that?
When we hit our cost.
Right. But if it was shipping point and it took a few days, then it could be earlier. Right. But here, since it's FOB destination, it's when they hit our dock. Okay. So what about that? Purchases or inventory for a periodic system? 50-50 chance, Lucas. Nathan, Eccles. Periodic inventory system, is it purchases or inventory? It is purchases. Periodic system we don't see very much anymore. It's when you basically put all your purchases into the purchases bucket. Then at the end of the month, you count your inventory. And by a process of deduction, you say, well, then my cost of goods sold must have been, whatever the difference is between the total opening inventory purchases and ending inventory. Okay, so let's just get like the frame of the journal entry, and then we'll figure out the amounts. We obviously paid on credit, right? Because we didn't pay the invoice right away. So I'm going to have a credit to AP. And the HST amount is $59.80. What do I do with that HST? Yes. Yes. It's a receivable, right? Because I'm going to claim it back on my HST return. So it's a receivable. It's kind of ironic that when you make a purchase, you generate a receivable, right? You always think purchases, payables, but for HST, you are going to generate that receivable. Okay, so then my question is, so we have 46,59.80 and 51,980. Which number do I put in for purchases? I mean, obviously it's not the 59.80 for the HST. Is it the 51,980 or the 46? What is my purchase amount? Yes. It is the 46. Yeah, because that's net what we're going to pay ultimately. What we actually do owe the supplier, though, includes the HST, so it's the higher amount, 51,980. And then we're going to claim back from like the receiver general, the 5980 of HST. I mean, you guys are just in your tax course, right? You and I, when we buy stuff and it has HST, we don't get to claim it back. Although you guys might get, an HST rebate deposited like my kids used to when they were students right into their bank account. So you're sort of getting it back, just not on a one-for-one basis, right? I'm not getting it back. When I pay it, it's gone. But businesses, they get to claim it back. Every penny, down to the penny, they get to claim that back. So that's what's happening here. So that's it for the first entry. And then we paid the invoice on February 20th. How much is this journal entry going to be? 46 or 51,980? Yes. Yeah, because that's what the payable is. We have to settle the payable. We have to pay out the HST with the cost of the goods that we purchased. So I'm just clearing the payable from my books and crediting cash. Okay, great. Now let's complicate things. On April 1st, PDSL purchased a truck for $50,000 from Schuler Motors, paying $1150 or $11,500 cash and signing a 1-year 8% note for the balance, and HST was charged. So now we've got a note and HST mixed in together in this question. Let's do the journal entry, like the bits that we know and that are easy, and then maybe the other parts will become clearer. So I would say that one of the easiest things to do is cash, right? Because you should be able to see, is the cash coming in or going out? If it's coming in, it's a debit. If it's going out, it's a credit. What's happening with the cash here? Yes. Going out. So we're going to credit cash for $11,500, right? Paying $11,500 cash. You know, you don't have to do the debits and credits in a particular order. If you want to put the credit to cash first, I'm fine with that. I'm just going to line it up so I have my, I mean, I usually almost always start with a debit. Sometimes I mix them up after, and I usually end with a credit. But anyway. Okay, so the cash. The other thing that's pretty straightforward is that I bought a truck for 50. And I know that what goes on my books is going to be net of the HST. So I could just put the truck on for 50. That's kind of easy at this point, right? So I'm going to debit the truck or fixed assets, property, plant, and equipment. I'm very open to whatever reasonable account names you make up. Don't say like equipment expense, but equipment, truck, PP&E, fixed assets, capital assets. I'm just going to put truck. 50. Okay. HST was charged by the supplier. Well, then I know I have an HST receivable, right? So that would be the next thing I'd set up. And that amount is $6,500. So 50,000 times 13%, 6,500. So then the remainder, the balance, was in a note. So that's my final credit to note payable. 56,500 minus 11,500 is 45 to balance. Everybody good with that? Pretty straightforward. Why do I have this frame here? What's that about? Yes. Don't forget to accrue the interest. I'm not going to say accrue interest on the exam. You see a note, you see a bond, and I say prepare all the journal entries for the fiscal year. Make sure you accrue. You know, it's like, I feel like you can probably do it. The question is, will you remember to do it? But that just has to be your reflex. Oh, I got a note. Got to accrue. Interest expense. Well, I'm going to take 45,000 times 8%. What's my proration? Works out to 2,700, but what's my proration? Yes. Yes, it's 9 months, 9 over 12. Sometimes people tell me 8 months because they see April and they think May, June, July, August, September. You know, honestly, on the exam, if you give me 8 or 9, I'm going to be good with it because, you know what you're doing. You can't count at the moment. You're in an exam. In real life, you will count the months correctly, but you understand that you need to prorate. But, you know, I actually do count, like, because just to be sure. Yes. Oh, God, I'm doing it again. Sorry. Okay, let's look at the third one. On May 1st, PDSL borrowed $83,000 from the bank by signing a $92,000 non-interest bearing note due the next May 1st. So they borrowed $83,000 by signing a $92,000 note. So you're telling me I signed a note that says on May 1st of 2026, I guess this one is 2028, well, whatever. On May 1st of next year, I will pay $92,000. And they gave me 83. What's the difference between 83 and 92? What is that? Yes. Okay, it's $9,000. Yep. What is that $9,000? Pardon? It's interest. It's interest. This may be legally true. They might call it lending fee, $9,000 lending fee. It's interest in substance. We account for the substance. So non-interest bearing, we don't believe economically, we don't believe that these notes are non-interest bearing. We always accrue interest. Even if it says 0%, you know, 0% financing to buy a car. It's not. They're calling the interest legally part of the price of the car. But let me tell you, if you tell the salesman, no, I can pay in cash, you're going to get a better price. Why? Because you're paying in cash. So then if I wasn't paying in cash, why would the price be higher? Is it interest? No, it's just that we charge higher when you don't pay cash. Okay, so translation, it's interest. It is interest. Okay, so first we're going to set up the note. Debit, we received cash of $83,000. Credit, note payable, $83,000. Now just think, on our balance sheet, we could literally have a line. If we had a detailed balance sheet, we could have a line. So I'm just going to write it down here. Liabilities, $92,000 note payable. They'd probably say, oh, they'd say the interest rate, something percent, note payable, due May 1st, 26, okay? And they would say 83,000. Can I say 92,000 note payable and put 83,000? Yeah. You know, bonds are like that, right? Bonds, we have the beautiful round number for the bonds, but the amount is this raggedy, ugly number related to the amount of, you know? So yeah, the name of the note is the $92,000 note payable, but the amount doesn't have to match the kind of legal name of the note. Okay. For the interest, again, we have to accrue interest because this is a note. So I'm going to get ready with interest expense and interest payable. For this note, as you mentioned, we have $9,000 of interest. How many months do we have to accrue for? Yes. 8 months. So we could figure out what the rate is, 9,000 over 83, figure out the rate, then do 83 times the rate times 8 over 12, or since we know the total interest, we could just do 9,000 times 8 over 12, which is very easy, right? 2/3 of 9,000 is 6,000. Make sense? You're always, always, always going to accrue interest on notes, right? Okay. This is one that I don't think we need to spend our time doing. It's pretty straightforward. Before I go on, I saw a good question from Omar. Omar asked a question about Part 1A, the order to buy goods for resale. Terms are FOB net 15. So Omar, I think you might be looking at an older version of the question where they said, oh, I forget the wording, but they worded it differently and there was a discount in an earlier version of the question. But now when it says net 15, they're just telling you, pay me within 15 days. You know, that's what they're saying. Or, you know, or we're going to threaten to charge interest. Although on AP, companies almost never charge interest. And they did pay within 14 days, right? From the 6th to the 20th. So they were fine. So no discount. All right. A dividend. Again, we have 3 dates and I have 2 frames. Which of those 3 dates? The 14th, the 31st, or September 10th? Which one am I not going to do a journal entry for? Which one doesn't matter? Yes. The date we declare a dividend is an important one. Let's do the journal entry for that on August 14th. What am I going to debit to declare the dividend? What do you debit for dividends? Not a trick question. How about online? What do you debit for dividends? Well, you could debit dividends. You could debit dividends. Or where it ultimately ends up. Yes? Yes, retained earnings. And then the credit is dividends payable because we haven't paid the dividend yet, but because it's been declared, we now have a legal obligation to pay it. 13,000. You know what would turn dividends, ding, 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 correct, into absolutely wrong, and I'm going to put a big X. Do not tell me dividend expense. That's totally gone off the rails because dividends are not expenses. We don't issue dividends to generate revenue. We pay expenses in hopes of generating revenue, right? Ultimately, it's all trying to generate revenue. Dividends, we're giving our shareholders a return on their investment. That's a return on the capital invested. It's definitely not an expense. So dividends are RE good, dividend expense, big X. Okay, now one of these 2 dates matters. September 10th or August 31st. Which one are we going to do a journal entry for? Yes. For sure, yeah. What do we mean on the date of record? What happened? What does that mean on August 31st? What happens? Yes. Yeah, that's the date where we like take a snapshot of the shareholder register and like you owe 100 shares, you own 100, you own 200, and we calculate the dividends based on your shareholdings on that date. If you own shares on August 14th and sold them on the 20th, well, you're not entitled to any dividends because you're not on the roster anymore as of August 31st. From the company's perspective, though, I mean, they owe 13,000 to whoever the shareholders of record are. So here we're just going to clear the payable because we're paying it. Okay, next one. On December 1st, PDSL received $750 from Jefferson as a deposit on a trailer that Jefferson is using for an office move. The deposit is to be returned after it returns the trailer in January. Is there cash involved here? Is there cash involved? Yep. Coming in or going out? Pardon me? Yes, exactly. Cash is coming in. Sometimes people will write unearned revenue, but no. It's not that we don't expect this deposit to turn into revenue. Unless, I mean, even if they damage the trailer, that's not revenue. That's just an expense that we're claiming back from them. This is just like a customer deposit liability. If everything happens as we expect, which is that they return it in good condition, we owe them the money. So yeah, when you see journal entries, if cash is involved, I'd always try to get that down first because it can anchor you. Oh, cash. Oh, therefore, oh, customer deposit. Okay, number 7, we did a few purchases. So why don't you just try this one yourself? The HST, just so you know, is, I think it's, yeah, it's 1040. HST 1040. So why don't you do that journal entry? You try it. I'm going to come and look over your shoulder, okay? Lucas and Nathan. Kate, Emily. And,
Last name.
and Miss Pendleton.
Yeah.
Is it Abby? Allie. I need to just knock, knock. I need to know your name because obviously I'm going to be using it. Lucas.
Luca.
Luca. Okay. All right. Thank you, Luca. But I'll use your, oh, I've already talked to you. Yeah.
Yeah.
Hussein. Zain Hussein. Yes. Keith. What's your last name, Keith? Dinga.
Dinda, D-I-N-D.
Oh, Dinda. Okay. Does everybody get this? I didn't look over anyone's shoulder. Let's see. See. Except there's not inventory. Right? Because we're not selling furniture and fixtures. I just put F&M.
Oh.
But you can put fixed assets or whatever. So I'm assuming that their furniture and fixtures are for their offices. I mean, I didn't think that was inventory. I guess since they're a department store, maybe. These are the types of things that you can argue with me on the exam. You know, when you get your exam back, I want you to look at your exam and don't be afraid to say, hey, I think she owes me half a mark. Sometimes students say, well, I don't want to bother you for half a mark. I think, why? If you earned it, you should have it, and I want you to have it. And if there's something like this, where only because Zane wrote inventory, and I said, well, that's not inventory, but then he could push back and say, but it's a department store. Why wouldn't it be? Okay. You know, if you have, I mean, even if I didn't intend it that way, if there's a reasonable way of looking at it, I'm good with that. But I'm going to still put furniture and fixtures, which in my mind is a fixed asset. Debit furniture and fixtures for 8. And I saw people were doing this correctly. HST receivable for the 1040, which means that the payable, because it's on account, is 9,040. Okay, so if you were able to do that, that's great. Another thing for the midterm, so we're doing HST a lot with this thing, with this question. On the exam, unless I ask for HST, then we're going to continue to pretend that HST doesn't exist. Okay, like most journal entries in this course, we're just going to ignore those details so we can focus on the issue we're trying to get at. So I will ask you specifically if I want HST. If you don't see me alluding to it, then just don't spend your time and cognitive bandwidth trying to do this, only if I ask. Okay, during December, cash sales of 79 were recorded plus HST, 10,270. That must be remitted the next month. HST is levied on the sale amount to the customer, and we're going to ignore cost of goods sold for just so that we can really focus in on how to account for the HST. So what's our basic journal entry to record a sale? Debit what, credit what? Good. Okay, so that's not going to change. Debit cash, because these happen to be cash sales, and credit sales revenue or sales revenue. I'm just going to put sales, like in my head. Revenue is like a umbrella term. And just for me, I think of sales. We usually say that when we're talking about sales of goods. And revenue is like fee revenue or interest revenue. But if you put revenue for sales of goods, totally perfect, fine. If you put interest sales, you just wouldn't put that, right? You wouldn't put that. You'd put interest revenue. Okay. What is the HST account? What's the accounting? Yes. It will be the payable because we've collected money from the customer. We immediately owe it to the government, immediately. So that immediately sets up an HST payable. So then we have our amounts. This is obviously 10,270. So where does the 79 go and where does the 89,270 go? Yes. Yes, it does. Yeah, because what we collected was 89, but not all of that was sales. Just 79 flat was sales. So you can, you can figure this out right in the middle of the exam. Just like think logically, obviously. Okay, we'll do this next one. PDSL's lease. Calls for monthly rental plus 3% of net sales. Retail operations usually have leases like this, where the landlord takes a cut of your sales. So this is very typical. We're assuming that this thing is going chronologically, right? We started in February, now we're in December. And I guess I know from the solution, wasn't obvious to me when I first looked at the question, but what they mean, 3% of net sales, and they're telling us that every sale was for cash in December. So what they mean is 3% of 79,000, which is 2,370. So our rent expense, our lease expense is 2,500 flat plus the 2,370 variable component, which is 4,870. Credit, the payment is due after month end, so payables 4,870. That's not a normal lease. Other than the variable component, what makes that lease not normal? Not realistic. Like you think about your lease. Yes. Yeah, when do you pay your lease payment? Pardon? Do you pay at the end of the month? I think you pay at the beginning. Yeah. Landlords don't say, sure, stay for a month and then pay a week after you're done. You pay upfront. But I guess it's a textbook question. So you can do anything. PDSL was advised during the month of December that it is legally required to restore the area, considered a land improvement, surrounding one of its new parking lots when the store is closed in 12 years. The fair value of this obligation as of December 31st is 46. Does anyone know what that situation is called? There's a very specific term that we use. Yes. It is. It's an asset retirement obligation. So we're going to credit asset retirement obligation. Or usually people just say, oh, that's an ARO. ARO. For 46,000. The other side of it is not an expense, at least not yet. It's set up as part of the cost of the asset. Just like something like when you buy an asset and let's say it's like some piece of equipment, you have to install it. You have to get the vendor to come and start it up and make sure it's operating properly. And all this costs money. So like the setup and commissioning of the equipment just becomes part of the cost of the equipment. And similarly, the future cost of taking that thing out and restoring the site is also just part of the cost. So it becomes part of the asset, which is land improvement. And then, of course, we're going to depreciate that over the 12-year life of the asset. And that's how that 46,000 is going to hit the income statement every year for 12 years. Often, deep inside the books, we'll set up a separate sub-account called the ARC, the Asset Retirement Cost. So it's debit ARC and credit the ARO. On the face of the financial statements, the ARC is just tucked in there with the land improvement, one big cost. And I'm going to leave this one because we don't need this one. Pretty straightforward. Okay. Why is the liabilities section of the balance sheet something that bankers are going to look at immediately when you ask for a loan? Yes. Yeah, like if I was lending you money, I'd like to know how many other debts you have. Because if you have a lot, then I will politely decline to lend you money because I don't know if you're going to pay me. So it provides information about other debts, amounts, and something that's important to banks in particular, well, everybody really, but banks, the priority of those debts. You've heard of first mortgages and second mortgages, right? So second mortgages are second priority. Usually banks don't usually do second mortgages. You'll get some financing company that is, willing to take a bit more risk. Because with mortgages, for example, what the banks have is the first like the first mortgage, if something goes wrong and you stop paying your mortgage, the bank seizes the house, sells the house, maybe in a fire sale, maybe it's a mess, whatever. They are paid out in full before the second mortgage holder gets anything. So priority is important, and that's something that's also conveyed in the liabilities section. Well, probably in the notes, the priority of each loan. Like AP, bottom of the pack. AP is unsecured, right? They just don't have priority. So if your customer goes bankrupt, you might end up getting pennies on the dollar because the priority lenders are going to get paid in full before you get 1 cent. Banks want to know, how are current assets and current liabilities related to each other? What's similar about them? Yes. They both have. You have to speak louder because there's a fan behind me, plus I'm getting old. They're what? High liquidity. Yeah, that's a good one. Yeah. They're both due within 12 months and probably a lot less, right? So 12-month time frame maximum, and like you say, probably a lot less. The other thing is you could say that the current assets sort of fund the current liabilities. You collect your assets, pay your liabilities. Collect your assets, pay your liabilities. Collect your assets by selling your inventory, by collecting your receivables, and then you can pay your suppliers, right? And people will often say that to their suppliers. As soon as the customer pays me, I will pay you. So the CA fund CL. Sort of. Okay. I should have put this title down here. If you have the new one, it will be down there. One more thing that is not in Pendlebury, but something that I feel would be fair game to ask you on an exam. Not a ton of marks, but a liability for vacations. Vacation accruals should be accrued when? When the compensated time is expected to be used, during the period following vesting, during the period when earned, or they should not be accrued unless there's a written contractual obligation. Which one is the best answer? Yes. Yeah, when earned. As you earn it, that's a liability for the company. And, vacation pay, statutory obligation, you have to pay people vacation pay. So even without the contractual obligation, there's a minimum amount of vacation accrual that's required. So C is the best answer. And now we're going to do warranties. So warranties. The approach that you've probably learned in the past is called actually the expense approach for warranties. Let's just go do the expense approach question, and then we'll come back to that multiple choice question. So this is the one, yeah, that I just changed just before class today. So yours may be slightly different in wording. It gets to the same endpoint, but I changed the wording because I just find it's probably confusing to students compared to what they've learned in the past. So let's just go through this. Jupiter provides at no extra charge a 2-year warranty with one of its products. So the product comes with a warranty. This product was first sold in 2027, and in that year they sold 2.5 million worth, and they estimate that it's going to take $488,000 in cost to service those 2.5 million of sales over the 2-year warranty period. And in fact, they actually spent 68,000 even within 2027. Like for the stuff that was purchased earlier in the year, some of it's already having trouble. Prepare the journal entries to record the sale of the product. I forget who it was. Was it Emily? Did you tell me the typical sale entry? Debit? Yeah. Okay. So we have the typical sale entry. Debit cash, credit sales for 2.5 million. Then they estimate warranty costs of 488. What's the journal entry for that? They estimate a total warranty cost of 488. How do we set that up in our books? Yes, at the back. Yeah, I'm going to call it a warranty liability rather than a payable, just because when I hear accounts payable, I think like, you know, I owe Hash Manny 46,000 plus HST. It's not, I owe them about 488 depending on what happens, right? So I wouldn't want to call that an AP. An AP is more precise. So I'm going to call it debit warranty expense, credit warranty liability. Whoops. Or warranty accrual, accrued warranties. You know, I'm open as long as it sounds like a liability. So that's the 488. And then we actually spent 68,000. So what do I do with that 68,000? Luca. Yeah, I'm going to start drawing down that liability. So I've already put the expense in 2027, like through the year. I put all that expense in. And even though I'm going to spend for the next 2 years, I'm not going to contaminate next year's income statement with warranty costs related to this year's sales. That's what I'm trying to do. I'm trying to like keep the costs in the same year as the sales and not start contaminating other years' income statements. So every time I spend, I'm going to just draw down this warranty liability. And it might be cash, might be AP, might be inventory, whatever it is, 68,000. That is the expense approach, which you've probably learned. Okay. So let's go back to this. Which of the following statements is incorrect? Using the expense or assurance approach, the warranty is provided with the product or service for free. Sort of philosophically, that's the way we look at it. That is correct. The warranty is just this free thing that comes along, but we do accrue the cost associated with it. Okay, that's the way we're looking at it. Where warranty costs are immaterial, or when the warranty period is quite short, like a day or two, we really don't bother worrying about setting up a warranty accrual. We just use cash basis. So that's true. The other approach to warranty accounting, called the revenue approach. Under this approach, the warranty is a separate deliverable from the related product or service. That is true. So now we're looking at it as a bundled sale. So think of your rev rec in 3330. You're getting two things for one price, right? You're buying the product, but you're really getting the product and a warranty. Just a different way of looking at it, right? That's the revenue approach. And no, the revenue approach is not used for income tax purposes, so that's wrong. We'll talk about warranties later. Actually, for income tax purposes, cash accounting is the approach that's actually used. But anyway, what we need to focus on is what that revenue approach looks like. So now, people always ask me, you know, when they're studying, how did you know that, Sent? How did you get those numbers? I made it up, okay? I changed the question so that it becomes a warranty approach question, okay? I just made it up. Do the 2027 entries assuming the revenue approach. So that means we're going to recognize the sale as a multiple delivery with the warranty as a separate service that's bundled with the product. So warranty, what we know in this case is that warranty agreements similar to this 2-year warranty are available separately and are estimated to have a standalone value of 600. So this is the same question, okay? So the 600, I'm saying, is the sales value related to estimated costs of 488, right? And are earned over the warranty period as follows. So we think that the 600,000 of warranty revenue will be earned 15% in 2027, 35% in 2028, and 50% in 2029, right? As the stuff gets older, more warranty problems. So prepare the entries to record the expenditure for servicing the warranty and the adjusting entry required, if any, at year end under the revenue approach. So first, we need to do the sales entry. The fact that we sold this 2.5 million. So we still received cash or AR. For 2.5 million. See how we didn't have HST? Because I didn't specifically say it. So then we're just going to ignore HST. And then we still have sales. This is for the product. But it's not going to be for 2.5 million because of the 2.5 million, we figure 600 is really related to the warranty. So it's only 1.9 million. And then we have our warranty of 600. So what credit account could I use for that warranty? Yes. Not liability. Well, it is something like liability, okay? You're going, yeah, you're going down a good path, but I definitely would not call it warranty liability. What would I call it, Emily? Unearned warranty revenue, right? Because the warranty period, as you're booking each sale, I know we're doing this in aggregate for the full year, but as you're booking each sale, the warranty, like, no time has passed. So we start off with unearned warranty revenue. 600. 600, not 488. We know that we expect the cost to be 488, but you won't see the 488. It doesn't, it's not set up like it is here, the warranty liability of 488. Different approach, different way of looking at the transaction. And then, so for 2027, we expect that we're going to earn 15% of that. So I'm just going to flip it out of unearned into earned warranty revenue. So let me debit my unearned and credit warranty revenue. 15% of 600, 90. And then, I mean, I did spend 68,000. So how would I book that? This is an easy one. Don't overthink it. I spent that money. Warranty expense. Okay. If you were a CFO or profit-oriented entity, and you could justify either the expense approach or the revenue approach, which one would you probably prefer? Revenue approach or expense approach? Nathan. You're going to say expense approach because the cost is up front. Just rather absorb the cost and be done with it.
Yeah, like take care of your liability.
Just get the liability on there right away. So you like to have liabilities.
Not necessarily, but at least you plan for it. So when the time comes to actually pay it, you know that you can.
Are you good at saving money, Nathan?
Not really, no.
No, I would think so. If you like to get your liabilities down right away, that's like me. I like to get them down right away, and I know they're there and they're not going to get out of control. So, but anyway, maybe, you know, when you get older, you'll get to be. Yeah, okay. Anyone want to vote for the revenue approach? Do you want to vote for the revenue approach? So, okay, you'd like to see, but cash doesn't change, right? Okay, okay, great point. Sales. Okay, so which one has the higher sales? Let's look at it. Sales. Nathan, sales are 2.5 million. What are your sales? No. 1.99. Your sales are lower. Most CEOs would rather get the sales in right away. You know, because, or CFOs, because you know what? I could be fired next year. That's next year. That's the next year guy's problem. That's not my problem. I'll take them right now. Thank you. So sales is better in the expense approach. Okay, so we like sales as CFOs. What are the things, what part of the financial statements do we not like? What part do we dislike? Luca? We do not like liabilities because that makes our leverage look bad. More debt, bad. Okay, which one has more liabilities? Luca? Which one? This one? Because they've got liabilities of 488 minus 68. So liabilities are 420. But what about, you're right, that's Nathan's approach. Yeah. Under this one, my liability, that's a liability, right? This is a liability. It's 510. Everything is better under the expense approach. Now let's just think about IFRS and ASPE and the heads behind those two sets of standards. One of those two sets of standards is quite directive. They put you under the thumb, and you're not getting away from using the revenue approach if you know, they force you to. With the other one, you might slip away and get away with the expense approach, which is the one that's going to put you under the thumb and sometimes make you use the revenue approach. Luca? Of course it's IFRS. IFRS is more picky, more conceptually sound, and they're telling you what to do more. They just are. So yeah, you'll see this. It's harder to get away with not using the revenue approach under IFRS, just the way those standards are written. Okay. You know, the thing that is confusing is when you hear revenue approach, you think, yay, revenue. Less revenue, more liabilities, bad. Okay. How am I doing? 2:13, good, 7 minutes. Let's see how far we can get through contingent liabilities. So under IFRS, with respect to threatened litigation, which of the following factors needs to be considered? Did you see that in the video? This is not a hard multiple choice question. This is much easier than the multiple choice questions that you're going to see on the optional midterm. This is what I call like a learning multiple choice question. So what is the answer? Are you guys online awake? Are you going to give me some answers? What's the answer? This is a learning multiple choice question, not a hard one. It is all of the above, yeah. The time period, the likelihood of an unfavorable outcome, and the ability to reasonably estimate the loss. Under ASPE, a contingent liability is recognized if, which of those three? So the ASPE and the IFRS standards are very similar. So knowing that, what is the correct answer here? A, B, C, or D? Since we've just seen what IFRS says. Which one of A, B, C? Yes. Yes, it is C. Which of the following may be accrued as a contingent liability? Another learning question. What is it? Yes. All of the above. Threat of expropriation of assets, pending or threatened litigation, and guarantees of indebtedness of others. Like if your parents co-sign on your car loan, right? If you're not good for it, all of a sudden they've got a liability that pops up on their books, but hopefully you'll pay for your own car, and it's just a guarantee that sits there, hangs out there, where it's only accrued if it becomes likely that you're not going to pay, you know, if your parents had a set of books. Okay. All right, let's look at this. Wilton Corp is being sued for illness caused to local residents because they exposed the people to chemicals. The lawyer states that it is likely Wilton is going to lose the lawsuit and they're going to be found liable for a judgment costing the company $600 to $3 million. but the lawyer thinks it's most likely 1.8. As a result of the above facts, what amounts should Wilton accrue and or disclose? So accrue means we put it on the books, we're doing a journal entry. Disclose means we're just writing it in the notes. So in order to accrue, you have to meet the 3 criteria, and you can see them here in the ASPE question. A liability, like something happened as of the financial statement date. So it appears in this case that something did happen as of the financial statement date because they already made the people sick or exposed them to chemicals, so that it's in the past. So we've got a check mark for that first one. It's likely that a liability has been incurred. So they did expose the people, and the people are going to sue them. And the lawyer is basically saying, you're going to lose. So it's likely that they have incurred a liability. And can we estimate what the liability will be? Yeah, because the lawyer's telling us. So we're going to accrue. Honestly, in the notes, you'd give more information about the lawsuit. So you would accrue and disclose, but kind of the first choice is it at the level where we're actually going to do a journal entry to record this? Yes. What is the amount that we're going to record? 600, 3 million, or 1.8? Yes, it is 1.8. Accrue 1.8 million. Now, let's just say, what if lawyer did not provide a likely amount, the most likely? We just have that range. So let's just do this again. We don't have the most likely amount, we just have the range. What you would do under ASPE and IFRS is different. So what do you think the options would be? What would be the 2 amounts? The ASPE amount or the IFRS amount? Like, what amount do you think would have to be accrued? What is reasonable that you would think would probably be something the standards would say? Yes. The average, or what we call the expected value, which happens to be the average for a 2-point. If it's every amount is equally likely between 600 and 3 million, then the expected value of 600 to 3 million happens to be 1.8 million. That's the IFRS approach. So now ASPE, they don't use the expected value. What do you think ASPE would use? Yes. Pardon? One of these 2 values. It is, yeah, the lower one. ASPE goes with the low end of the range. But if the lawyer can specify, look, I think it's going to be 1.8, then they would both say, use the most likely amount. And if there's no most likely amount and you just have a range, this is how you treat the range. Okay. How am I doing? I'm done. Okay, we're done. So on Thursday, just bring back this same thing and we'll finish them.